Hi, everyone. Welcome to Colliers Canada's second multifamily webinar dealing with COVID-19's impact on the multifamily asset class. 30 days ago, we had a lot less information around rent collections, how the investment community would underwrite deals through this pandemic, etc. Today, the picture is getting a little bit more clear. So we're going to answer what's happening now, when will pens be up, what strategies are property managers using to navigate this environment, and a whole lot more. To help us answer this, we have an expert panel. So let me introduce our panelists, most of whom you probably know, and that's why you showed up. But nonetheless, we have Mark Kenney. Mark Kenney is the president and CEO of CAPREIT. CAPREIT's a publicly traded company listed on the TSX. CAPREIT's portfolio consists of over 64,000 residential rental units and land lease sites across Canada and the Netherlands. CAPREIT also manages Irish Residential Properties REIT in Ireland. CAPREIT is Canada's largest multifamily owner, not including Toronto Community Housing. Rob Watt. Rob Watt is the co-founder and COO of the DMS Group. The DMS Group is one of Ontario's largest property managers, property types including retail, industrial, office, raw land, and the reason we're here today, multifamily. DMS is a third-party manager for over 20,000 units. And I read, actually, DMS has ranked as Canada's largest residential property manager by RBH Magazine. Matt Bruchkowsky. Matt Bruchkowsky is one of my colleagues at Colliers. Excuse me. He's an executive director at Colliers on our appraisals team. He's a practice leader with a specialization in multifamily and land. Matt's a market leader in these categories. He's known internally, mostly by me, as the Wayne Gretzky of appraisals. And then last but not least, we have Tony Irwin. Tony is the president and CEO of the Federation of Rental Housing Providers of Ontario. They've been the voice of the rental housing industry since 1985. FRPO's members contain everyone from property managers to somebody who owns a single property, all the way up to the largest institutions that you know. Their members collectively own 350,000 units. So we have the largest owner, the largest manager, the top apartment appraiser, and the leader of FRPO, who has insights across a broad range of spectrums there. So why don't we dive in, and actually, just before we dive right in, I want to say to our audience and those following along, we can see what you write in the chat. So let us know if we have questions. Hopefully we'll answer most of them, but if you have something that pops in your head, shout it out and we'll get some insight here. Okay, so the first question, let's just get right into it. How is the market performing? We can talk about April and May rent collections in Ontario. Rob, I'd like to start off with you.
All right, thanks, Dayma. Pleasure to be here this afternoon. Great panel. Rent collection has been better than expected. We really weren't sure what to expect in late March and April, and rents came in probably at a level many of us were surprised by, and that's continued in May. We're very satisfied with what's going on. We're not at 100% by any stretch, but we're well in the 90s and working closely with our tenants who aren't able to pay and working out deferral agreements. We have some credit incentives and so on to try and help people through this tough time. But the collection side has been stronger than expected.
Yeah, right. That's kind of what we're hearing. And same, it just continues to surprise us each month, it seems. Mark, do you have a different perspective, or are you seeing much of the same kind of across your broader Canadian portfolio?
Well, I think on the investment side, relative to other real estate sectors, the news is positive. But I think from a resident Canadian citizen impact point of view, it's profoundly bad. And I only say that when you think about the fact that historically, when you look at what trailing receivables are, for landlords, multifamily landlords, I'm sure Matt could give us the number, but probably uses a bad debt number of around 0.5%. Okay. When you see rent payments at 90% levels, this is a massive number of Canadian households that are affected. So there's two different lenses of this. From a investment point of view, resilience point of view, yes, multifamily's done relatively well compared to its peers. But from a Canadian citizen impact point of view, this is very, very disturbing. And I would also add on top of that, I think that our government, our federal government, responded quickly with the CERB payments, which definitely helped in the process. But let's not be fooled. If these CERB payments were to fall off, I think we would find ourselves in a very, very different place of investment quite quickly. So I agree with Rob, relative to what we were fearing as apartment owners and investors, the worst didn't happen. But relative to the impact to Canadians, it's quite profound and early innings still. So I wouldn't be quick to, conclude anything at this stage, other than, there's dramatic change going on out there. Just like, not to go on, but when you think of it, the fact that, just under half of Canadians live in a rental household, to have 10% of them unable to make rent payment in some cases, I don't know if that's the general number, portfolios differ, that is a huge number of Canadian homes. That's basically 5% of the households in Canada. 3-4% are in severe economic distress already, pre-CERB. So that would be my take.
Yeah, that's a sobering insight from you there, Mark. I thought we were going to just talk fluff this whole time, so that's good. And then Tony, you interface with a lot of these, in addition to the larger institutional guys, a lot of these private ownership groups. Are they feeling the pain as well? Is there any difference between what we're seeing between the larger guys and the smaller landlords?
So first of all, yeah, I think if you wanted fluff, Mark Kenney's not the guy for that. So Mark's going to bring it, and it's good for me to follow Mark, because he, of course, sees it on the ground every day. And so in terms of your question around small versus large, I talk to different landlords, of course, who have different portfolios and different sort of situations. And I think Mark would agree with this. It's not about whether landlords are hurting so much. We're all hurting to various degrees. Obviously, we know how other industries are being impacted relative to multifamily, but I really agree with Mark. He's hit on the right point, which is that while, from a maybe a numbers term, you talk 90%, and we're collecting May data. We waited a little longer this month. Our experience in April was you get out of the gun quickly. What you collect is not really reflective of a full month's payment cycle. So we're waiting a little longer in May. So we'll see what that number, what that data looks like at the end of the month, or as we're getting it. But 90% that Mark alluded to, say it's somewhere around that. That in and of itself is perhaps not a big number in percentage terms, but I absolutely agree with Mark that what it translates to are the number of Canadian households that are still having difficulty paying rent. That's the important part of this discussion. And, the different dynamics at play. I've talked to small landlords who have had everyone pay. I've talked to small landlords who have had not all, who have had not full rent collection. The same goes. I don't know that it's a small versus large scenario so much as it's just, case by case, individual basis. There are still a large number of families who are not able to pay their rent, and that's where the focus really needs to be. It's on helping those individuals and those families pay their rent, so they can, they can sort of, be safe in their housing and secure. That's really what I think the important part of this conversation should be.
Right. Yeah, it's a great insight. I'm excited. Later in our conversation, we'll jump over. Maybe we talk about a couple different submarkets as well. But first, Matt, I'd love to jump over and get an understanding of what you're seeing in the appraisals division. Have you changed the way that you're underwriting deals, like what are the major, a lot of what you're doing has changed, I've got to believe. What's going on there?
Yeah, so it's interesting. I mean, as an appraiser, as you all know, we have to be dealing with real-time data, not thoughts or conceptions, just hard facts based on transactions. As you can appreciate, that is very challenging right now. And, you know, I speak with other appraisers, I speak with all the market participants, and some people are saying, you know, how can you not raise caps? How can values be the same? And we're not saying values are the same, but we're just taking a very cautious approach to adjusting cap rates or vacancy numbers, you know, for something that will pass. I mean, this will pass. It's a matter of time. It's a matter of when, but I don't think Mark or anybody out there are buying assets with a 2-year hold. It's a longer term horizon. And we have to remember a cap rate is a yield metric into perpetuity. So the tools we're leveraging, you know, our process has changed in that we are taking a hard look at each asset on an individual basis, looking at the rent roll, taking more time to interview the client to understand, you know, if there is some delinquency on payments, are they the usual suspects, the people who always pay late? Understand each asset on an individual basis instead of broader strokes of the market, which we kind of used to do because it was so robust and things were very tight. You know, I'm on the phone most of the days with clients, people looking to buy, people looking to sell, and I'm not seeing my clients underwriting very differently in terms of yield metrics or cap rates. I'm seeing them provision for shorter term speed bumps. So what we're doing now is we're doing a 10-year cash flow. We're, you know, sensitizing it, what might happen year 1, year 2, and then will things stabilize? I mean, it's just a guess, but at this stage, because nobody knows, but it's no different than a DCF on a retail plaza or a Yorkdale. Like you don't know what's going to happen at renewal. You don't know who's going to stay, who's going to go. So we're using some of those tools and looking at a longer term horizon and just kind of sensitizing it. You know, any assets with significant vacancy beyond stabilized level that we're comfortable with, we're adjusting below the line instead of above the line. So we're not factoring into the NOI basically. We're just taking it after we cap it out, which is, you know, a good technique to recognize that it will stabilize at some point. But, you know, we're having lots of conversations and a lot of my clients are still busy underwriting and the pens are, you know, to paper running the numbers. And when they're asking, are you comfortable with this valuation on an appraisal basis? I'm not seeing a huge change in what they would pay previously. And again, my scope and my territory is Ontario. You know, we have an Ottawa office, so I don't touch that market, so I'm not speaking to, you know, out west or anything. We have professionals out there, but in kind of the GTA and Southwest Ontario, things still seem very strong in our opinion. We're just taking a hard look at NOI and we're sensitizing turnover and trying to understand where rents, you know, will go. You never know what's going to happen, but, you know, we're running various models as well, where we look at in-place rents, in-place quality of suites, and then we're looking at the renovation, the value through turnover. So a little bit more is going into it, and it's a bit of an art just to play with a number that we're happy with, and you know, we're in touch with guys like you, Dayma, on the daily, and all the brokers to see what people are talking about. And I'm not seeing a huge adjustment. I think Mark can probably comment on that, and you, Dayma, given you're living and breathing the transactions. But I'm not seeing anyone willing to sell for a haircut, and you know, maybe people are looking for a haircut, but I'm not really sure it exists.
Yeah. I would agree, and I like the you know, reflecting on the thought that this year one, what we're seeing with slightly higher vacancies, and maybe it's harder to fill units. Well, you know, that is only 5% of the value when you're actually projecting out cash flows and everything. So, okay, Rob, let's jump over to you. Let's talk about management. You've got 20,000 units or so under your belt. What's changed in that field? What are you seeing on the front?
Well, yeah, we've taken the position from the beginning to leave all our offices in the apartment portfolio manned. We're in what's called a restricted access mode. So the staff are going to work every day, kind of closed door to the public, to tenants, and servicing both leasing, maintenance, tenant communication from those offices in a safe manner. And it's worked extremely well. We've implemented bonus schemes for our staff that are in the front lines. So sort of akin to what some of the grocery chains did. We implemented a site staff bonus regimen in the middle of March. And as I say, things have worked out really well for us. We've been fortunate that we haven't been adversely affected on our roughly 450 employees with respect to people being off sick or having to be away from work. For the payables, receivables, preparation of financial statements, we're in a remote work mode. So our accounting team is working from home and cycling through our 3 sort of regional and head office on a kind of once a week, twice a week basis. So we, reduce our human footprint in those locations. And we've been able to process all our payables, receivables, and so on time and with very little disruption. It's been a bit of an eye opener, actually, how successful we've been able to perform in this environment. Obviously, though, we're building up a backlog on routine maintenance. In the buildings, we're doing life safety and emergency maintenance only. So with each week and month that passes, we're building a backlog of what would be normal routine maintenance. So when this pandemic situation stabilizes one way or the other, we are going to have a mountain of work to do in suite. And it's not just that our guys and our vendors don't want to go in units. It's the our residents in our communities don't want people in their homes either. So there's like a lot of mutual respect going on there right now just to keep everybody safe. And we're dealing with just urgent maintenance, life safety items only. On the leasing side of things, we've moved into a fully virtual mode. So we're doing a lot of video. Our website includes a lot of video tours. We're doing Skype person-to-person interviews for leasing candidates. We're hosting Facebook open houses, which is kind of fun, where people can register for an open house, and in some cases, these have been very, very successful. But let's face it, the turnover volume in April and May is less than last year. And, obviously people that do not have to move are sort of being cautious, and that's affecting turnover rates.
What is the turnover rate?
Said that though, the leasing's been reasonably strong, and I think is going to get stronger. I'm as you can tell, I'm pretty optimistic on what's happening in the market. And I think, as the spring turns into summer, and people, just the psychology of us as human beings on this planet, I think people are going to start to want to get back to normal and going to start making decisions about moving again. And I think we're going to see the turnover rates increase as the summer goes along, and we're ready for it. We're doing move-ins now in a very particular way. Parts of our portfolio, we're doing certified germ guard treatment prior to move-in, providing tenants a certificate of health of their unit. Really trying to make people understand we're doing this in as safe a manner as possible, making them comfortable with leasing. And the market has been okay. I think it's a little softer at the top than it was last year for sure. So in those rents that are more than $3,000 a month, there's definitely been a softening at the high end. But let's see what happens. I think Mark said it. There's no way we can benchmark or start doing projections based on what we've seen so far. We have so little data. We're just at the very beginning of this thing. And I think, we're going to have to ride this out for a while to see what the new normal is. It's really hard to predict what's going to happen next month, given, how recent this really is. I mean, middle of March was kind of when it all hit us, right?
Yeah. Rob, can you share with us some of the numbers, some of what you're seeing in terms of, you mentioned turnovers down. Is it down to 50% of traditional? Is it now 5% of the units are turning over? Is it, and also what sort of level of interest are you seeing on your apartment listings?
So obviously we only operate in Ontario, and there's lots of sub-markets in Ontario as well. But I think it's safe to say that across Ontario, across our portfolio, our April turnover was probably off about 20%. Our May turnover is more like 40% off compared to last year, the same month. But I think, again, I don't want to draw too many conclusions from that. I don't want to draw a graph that's showing, 20%, 40%, 60% in June, because I just don't think that's the way it's going to be. I think when we extrapolate out on the numbers we've seen so far, it's based on so little data. It's really hard to make any concrete decisions. So what we're doing is assuming the market's going to be there. We're making sure we're aggressively leasing in all our markets and trying, as I said, to make it as easy for people to lease in this COVID environment as possible, and provide a safe experience when they do move. We'll have to see. I think there's a lot we don't know at this point. Let's put it that way. As Mark said, there's a lot of Canadian families that have been really impacted by this, and the government has spent $250 billion so far at least to try and help businesses and individuals. So as Mark said, if that continues, I think that will indicate maybe one thing. If that starts to get pared back, that's gonna drive some very different results.
Right. Okay. We're actually getting a number of questions that are coming in through the chat, which is awesome. Jason Birnbaum says, sounds like he's saying short CAPREIT stock. So Mark, I'll give you an opportunity to address that one. Not yet. First, I want to speak with Tony. Tony.
Not a second. You're going to make that comment and talk to Tony.
Okay. Well, because I want to sneak back to you once we start talking more about
Okay.
because obviously CAPREIT is active. So, okay, Tony. So there's a small but very loud collection of tenants who are pushing forward a movement. I'm sure you've heard of it, rent strike. Particularly, you're seeing this in certain submarkets in Toronto. I'm sure that maybe it's happening across the country in certain areas, certain little pockets. Can you tell us a little bit about the full story and I don't know, Rob, if you want to jump in, like how do you manage that within your building?
So I'll just speak briefly to the activity itself and what we have seen manifest itself as a result of the pandemic. Obviously, the rent strike movement in and of itself, and everyone, Mark and others know plenty about it. It's gone on for some time. It had been sort of, I think the catalyst for it were AGI applications in buildings where tenants would sort of be organized to try to, fight these applications and just not pay rent. They say they sort of ebb and flow, whether it was in Toronto or Hamilton or Ottawa, different places, you would see them occurring. Different groups, Park to Organize, Herongate would sort of mobilize people perhaps to engage in that sort of activity, which of course is wrong and is illegal. You sign a lease, you're obligated to pay that lease. You're not, I don't believe it's appropriate to simply say you're not going to pay rent. If you object to something, we have a means to arbitrate disputes at the Landlord Tenant Board, and that's how that should be done. More recently, during the pandemic, it's really taken a more ugly turn, I would say. A few weeks ago, we had incidences of protests occurring at private homes of some of our members. It was actually took place on the day of the FRPO annual general meeting. I have no doubt that if that meeting had been held at our office as opposed to on a format like the one we're on right now, those protesters would have been in our office and would have been sort of trying to disturb our meeting. Because they couldn't do that, they obviously chose a different path, one that's very disturbing and troubling to us and to me certainly. I think once you sort of cross that line from protesting at a workplace, I don't think any protests are necessarily wonderful, but we know that people do have that right, and that's one thing. But to take it to people's homes, I think is a totally different situation entirely. I think that's, as I say, I think that crosses a line. I don't think that's appropriate, and so certainly that is seeing that, and it was quite disturbing to us and to the members who had it happen at their homes. I think just not something that anyone would want to have happen to their families. Enduring that. And if you looked at the news footage from it, it wasn't one or two people; it was a lot of people. on lawns and knocking on doors and putting things on doors. So I guess all I'd say about that is certainly we're in touch with government officials about that. We know that we have been targeted before and will be targeted again, but I don't think this kind of activity is in any way constructive. I think it's not something that most people think is in any way appropriate. And, you know, again, the greater issue here are Ontario families who are not able to pay their rent. Let's, you know, the common call here should be to governments to say, we need assistance from government to help people who need it, not attacking anyone, not attacking us. I don't think that's the way forward. And I really would hope that this kind of behavior would not be repeated. But unfortunately, I suspect it probably will be.
Well, I'd like to add to that, if you know, there is no question that families in need support, period. But families whose income are not disrupted, the pandemic is not an excuse to not pay rent. So when an organization calls for all people, regardless of their economic situation, to not pay rent, then you're just challenging the core of Canadian values. Why are groceries not free? Why are our vehicles not free? Why is clothing not free? Why are the demonstrations not happening outside the personal homes of every business owner in Canada? And I would put that on the Colliers group as well. Like, think about it. At the core of this thing, this movement believes that the pandemic justifies not paying rent, regardless of the person's economic impact. Don't pay rent. And it borders on hate in my mind. To Tony's point, when it goes to the doorsteps of somebody's home, then it starts to become a topic of hate and resentment versus a topic of need and compassion. And the real topic needs to be around addressing the compassionate needs of Canadians that are economically impacted, not Robin Hood mentality.
Yeah, I think that's very well said. Somebody in the chat says because landlords are an easy target.
If I can just say one more thing, Dan. When I've been doing being on media, I was on the agenda last week, and our message, and I think Mark says it too, is very, I think, a very straightforward one, which is if you can pay your rent, pay your rent. If you can't, speak to your landlord. You know, we are here to help. We are here to come up with a plan, rent deferral. There's all kinds of things that we can and are doing every day. But that's the way this conversation needs to take place. It's because of the tenants who can pay rent that we can help those who cannot. It's pretty straightforward. This isn't rocket science, but we need people, and it's been said by whether it's Premier Ford, Mayor Tory, others, if you can pay, pay. If you can't, speak to your property manager or landlord, and we'll help you, because that's what we're here for, and we will do that. Mark is doing it. You know, Rob is doing it. All kinds of people are doing it every single day. And we're not doing it for accolades we're doing it because that's what you do. We are Canadian. That's what we do. That's our value system. And we'll keep doing that. But we need people who have not been economically challenged, of which there are many who have not been, and whose economic condition is largely the same as it was before, to continue to maintain their obligations. And those who can't, we will help them and we will get through this. But we have to do it together. We have to do it in a way that's respectful, that's compassionate. That's certainly what I believe. And I know my members believe that as well.
Yeah, well said. And by the way, guys, Mark, you said throw it to Colliers. Yes, we're on the same page here. Can you guys see the little chat that's going on the side, or is that just me?
I see it.
Okay,
I see it.
Okay, great. Okay, so Mark, I mentioned briefly somebody's getting cheeky in the chat box there. And because you were expressing concern about Canadians and the public, they said, oh, it sounds like an opportunity to short CAPREIT. Do you have a response? And also, what's your outlook? Is CAPREIT doing transactions right now? Maybe that's kind of a lot of questions in one, but.
Okay, so our to address the shorting CAPREIT, whoever wrote that in, I'd like them to go do that, because they're going to lose a lot of money. The reality is that what people should be talking about, not transactions, but earnings. and I think we're touching on earnings. What we've learned is that apartments are very resilient. What we've forgotten is, and for young guys like you, Dana,
Yeah.
We've been through bad economic cycles before, and apartments used to be called counter-cyclical. Okay, and what that meant was we did well in bad economic times. Now, what happened is in Canada, because of the affordability of Toronto, Vancouver, Montreal, we started doing well in good economic times. But we also know that just looking across the border to the US or looking anywhere in the world where there's been economic calamity, apartments do well in uncertain economic times because people don't want to invest in the real estate market, or they can't invest in the real estate market, or the real estate market doesn't have its legs. So you just have to remember what happened in the US when the mortgage market fell apart and things got rough there. Apartments surged. Okay, so I do expect, as it's always happened historically, apartments to do well in uncertain economic times, which we are certainly in. I do expect apartments to do well in bad economic times, where we certainly could be going. Okay, if mark-to-market rents are not where they were pre-pandemic, we will definitely see an offsetting benefit of increased apartment churn or turnover. Okay, and that will reveal itself because there are uncertain economic times. Okay, when people lose their jobs, they go home. When people lose their jobs, they double up. When uncertain or bad economic times happen, it naturally creates churn everywhere, changing movements. That will definitely reveal itself in the apartment world, is my view. And the actual yield of apartment buildings could go up, even if mark-to-market rents go down, because you'll be tapping those mark-to-market rents, those lower mark-to-market rents, in much larger volumes.
Right.
So I think that the cost environment is very favorable. We just did 10-year money at 1.57%. That is extraordinarily favorable. If you look at cap rates in Canadian history, pre-pandemic, many apartment deals were being done between 70 and 120 basis points of spread between the cost of long-term money. If you take 1.5%, 1.6% money, and you're looking at a 3.5, 3.6 cap, that's 200 basis points of spread. We never saw that in the last recession. So Matt's making notes right now because he realizes that cap rates are actually likely to go down, not go up, for two primary factors.
Busted.
The first of all, number one, apartments have shown themselves to be resilient. So all forms of real estate investment are likely to guide towards apartments. Okay. Secondly, an increase in income due to financing rates and overall decreased costs that are not reliant on these new mark-to-market rents that we saw pre-pandemic. So to the gentleman on the phone that was going to short CAPREIT stock, I hope he reverses his trade and doubles down and buys, because I think that we're, if anything, looking at an optimistic future.
Yeah, I mean, hopefully he's optimistic too. He owns a ton of apartment buildings as well.
Well, he should be putting all of his money in CAPREIT stock.
Yeah. And Mark, further to that, is CAPREIT currently executing deals? Are you out there buying right now?
So it's, again, we're weeks into this thing. It's very difficult to do due diligence when there's a lockdown. We're not putting our people at risk in terms of being on the ground looking at acquisitions. But that it's really a logistical barrier right now. The capital markets are finding their footing in terms of valuations, and I don't think there's an urge for us to act right now, simply because we have a great portfolio and we don't need to. Okay. But should value present itself, CAPREIT's absolutely in the market of buying value. Now, value, I'll just rant on here for a second. What was value pre-pandemic versus post is very, very different. What we've learned in a pandemic is that it's not all about big cities. It can very much be about secondary markets. And in particular, it has a lot to do with seniors in secondary markets. So the best performing assets across the country have been buildings that are full of seniors, okay? Because their incomes are undisturbed by the pandemic. Their investment portfolios may be disturbed, but their income is in general not disturbed. So if you wanted to have the most resilient portfolio possible, you'd be invested in the seniors market anywhere in the country, okay? So the mark-to-market opportunity of the big cities doesn't look as appealing in a pandemic in the short term, because it's a big city and that's where the pandemic is affecting things the most. So you see some extreme examples of buildings that are highly affected and then buildings that are completely unaffected. And it has nothing to do with the old talk of urbanizing large cities and secondary markets. It has nothing to do with that right now. It has to do with the demographic of who your renting population is. So I don't think that's something that's just proved itself out during this pandemic. I don't think that's a pandemic phenomenon that we're seeing. I think it's moved our minds to, it's not all about, secondary markets can be resilient as well, depending on who's in the buildings of those secondary markets. In Ontario in particular, we're less reliant on manufacturing, and that used to be the old secondary market problem, is manufacturing would highly disturb the quality of your investment in a secondary market. That bubble is gone in terms of impact. And even during this pandemic, I don't think we're going to see the same effects in the secondary markets because they're not as manufacturing based. Unfortunately for Canada, unfortunately for Ontario, we lost manufacturing in the secondary markets due to government policy and bad decision making. But that would be my overview, is that it has a lot to do not with the location, it's the demographic of who you have in your location that people should be more mindful of.
Great, that's great insight. Tony, let's kick it over to you. And I think there were a few questions in the chat, but maybe we'll circle back. Tony, is there anything that's keeping you up at night as you kind of echo all of the major landlords? Is there anything truly concerning to you? And on that same note, is FRPO working on anything interfacing with the government?
So I guess the things that concern me the most in terms of where we are today and perhaps going forward, I mean, we've talked about, rent collection, and I think we've talked a lot about the number of families that are being impacted, as well about sort of where things go from here. I think it may have been Mark or Rob touched upon, what happens when the federal government turns the taps off, which at some point they're going to have to. Right, the money can't go on. Is not limitless. So at some point, some of these federal benefits will end, and what will happen then? So that certainly is a concern in terms of how will for Canadians who have lost their jobs or been laid off from jobs, who won't be able to return to those jobs because those jobs will not exist in sort of a post-pandemic recovery. They're existing because of whatever savings they might have, whatever federal benefits they're receiving. What happens when that ends? How will they go forward? How will they be able to buy groceries and pay rent? So that's certainly one area of concern. Certainly the other thing that we do think about and has been some discussion I've had with Mark over the course of the pandemic, of course, is the issue of the landlord-tenant board. And certainly we know that evictions are there's sort of a moratorium on evictions right now. We understand why that's the case. Certainly we don't want people losing their homes during a global pandemic. However, you don't have to go far from any media source or spend a bit of time on the internet, and you obviously see stories of things that are happening, whether it be enforce being issued or we know there are going to be sort of circumstances. The board is going to have to resume at some point. There will be. We know that it had a backlog to begin with. It wasn't the most efficient organization. We've been talking to government about that since the Ford government was elected 2 years ago. But the challenges of the landlord-tenant board, those challenges will be exacerbated by whatever multiplier you want to put on that. as a result of the pandemic. So while we're very aware of decisions governments made to manage the pandemic, we also hear from members and others about what's going to happen when we get to sort of get through the worst of this, if you will, and how will we actually sort of what will the government is, of course, looking at what reopening the economy looks like. How does that look for the landlord tenant board? So that's certainly something that we are concerned about, speaking with government about. They're not really at a point where they want to engage significantly in that issue yet, but they're starting to get there. They're starting to sort of realize that they're going to have to look at that and look at what that looks like. Obviously we're all conducting business differently than we used to. So is it online hearings? Is it paper hearings? What will it look like going forward? Bottom line, though, we know it has to look like there's got to be some sort of plan for bringing that back. So that's something that we are certainly focused a little bit on as well.
Right. Okay. And then one last throw to you, Tony. Somebody asked, will the landlord tenant board provide rent increase / decrease guidelines for 2021? That's what that was for you.
Have no insight on that, but I would assume they will.
Okay. All right. Okay. Let's go through these questions because people have been submitting, and we're very lucky to have a very engaged audience. And if you see some of the names here, these are some of the private owners of apartments across. So it's a very astute observers here. Let me see this here. So just bear with me. I'm just ripping through this. So somebody had directed a question, I think, Mark, towards you about purpose-built rental apartments and how that market's going to fare. Can you comment on what you're seeing? CAPREIT has a bunch of development land and maybe some projects under construction. How do you think the purpose-built rental market's going to be affected moving forward?
We have a serious supply problem in Ontario. There's just no stopping that. The barriers to building rental have been there for decades now, and we were finally starting to enter into an environment where we could make purpose-built happen. Long term, there is no question building rental is a sound investment for all the reasons that we've talked about. The question will become, how much support for the industry do investors lose with things like the tribunal being shut down, with uncertainty, with these rent strikers that are threatening to pay zero? The more momentum that gains around those issues, the less interest you'll see in anybody building rental. And potentially the less interest you'll see in people wanting to own the asset class. So government has a large role to play in supporting the industry in this regard. I think that the prospects are definitely there for building rental going forward. We're excited about our program. Will they be pro forma at $5-6 rents a foot per month? Probably not. But we'll see the economic impacts of what happens here. But what will happen to costs? Will costs come down because we were in an overheated condo building environment? Will development costs be addressed by government? Government, again, has a huge role to determine this outcome. If government is unsupportive of our industry, why would the assumption be that our industry is going to build into it? I'll tell you, this rent strike thing really has me wondering, where is government on this? They're turning to the players that are going to deliver the supply, but are they going to support those business people during these times? We'll see. That has me more disturbed than the fundamentals of building rental. The fundamentals of building rental in this country are extremely, extremely strong.
Right. Yeah, it is. It does make it certainly a tougher environment to be a landlord when, our mayor or our premier are really just telling the landlords, "Hey, go easy on everyone." And it's, of course, you're doing your best, but it is a business at the end of the day as well, and you can't be taken advantage of by people who still have an income and just don't want to pay. Let's get back to our regularly scheduled programming here. Mark, another question for you. So CAPREIT recently announced they purchased 1,500 apartment units, 8 multifamily properties from QuadReal, a $390 million transaction, largest real estate transaction in Halifax's history. Can you tell us a little bit about how this deal transpired? And, is there any added pressure on kind of larger scale deals like this? There's your deal now. There's Starlight and KingSet's bid for Northview. Do you have any remarks on that note?
Well, I did see in the comments there, we do have the best acquisition team in Canada.
You're right.
So we're able to get great visibility on deals. But at the end of the day, I don't care, but there's no pressure for us to buy. There's pressure for us to create value for shareholders, okay? So whether we create that value through the existing portfolio or through the purchase of new property, that's our job. Our job is not to compete and win. That's how people go broke. Our job is to create value. So in the case of Halifax, we really believe in the urbanizing story of Halifax. This is a absolute core portfolio in terms of its walking distance to downtown for the most part, perfectly complements our existing portfolio there, and significantly below replacement costs, which I pay a lot of attention to. So great property, some would argue expensive, I would argue absolutely screaming value on a number of fronts. QuadReal was obviously a great owner, but we see tremendous repositioning opportunity with this portfolio, and unbeatable locations, like not replaceable locations. So that would be my comment, that we will always be in the market when there's value, and we will not be there when we don't see it. But it's got more to do with the ability to create value than it does competition.
Right. And Mark, when you talk about creating value, are you, and maybe this is a question for you too, Rob, are you guys still renovating units when they become vacant? Are you, like, how are you creating that value in this very short time period?
Well, I'll let Rob comment. It's been very difficult to do any sort of sizable renovations during lockdown. So just for employee safety and not having 2 people in a unit in close proximity to one another at the same time, we have scaled back. I think others have also done that. But again, this is another one where I wouldn't call a trend, because, it's just logistics. And, it's even hard to figure out what market rents are right now, because in some cases there's nobody in the market. And that doesn't mean there's no market for rentals, that people are in lockdown and just not renting. So, I'd be very hesitant to kind of, again, draw conclusions from a pandemic at this stage. As Rob said, as we open up, it'll get back to normal. We'll start to be able to figure these things out. But when you're not allowed to move, you can't really make any sort of conclusions.
Right. And Rob, another question for you. So, in 2008, 2009, well, actually, I think DMS started in the 90s, right?
Yep.
You've been around for a number of years, seen a few cycles. Are you seeing any similarities between what happened in 2008, 2009? And with that in mind, where are your expectations for, vacancies and turnover and all those metrics moving forward? Very different situations, but. Yeah,
I think, the comparison to 2008 credit crisis is not a very good one. We're not seeing a lot of similarities between that market and this market. I would say that in some of our submarkets, that this is closer to like 2001, sort of tech bubble times where, vacancies were starting to climb and so on. But as I said, it's so early in this thing. I would hate to make any predictions, but it does mirror 2001 a bit closer. And we're starting to put some, rental incentive packages together that we haven't seen in a long time, especially at the high end, to try and encourage renting. and some of our sub-market classes like student housing and so on, where we're putting our real shoulder to it and trying to encourage people to rent in an environment where schools are working online. So yeah, I would say it's a closer comparison to maybe 2000, 2001 than to 2008. And with respect to turnover rates, again, pretty hard to talk about turnover when we've got kind of 6 weeks worth of data. But
Right.
I will say that, most of our landlord clients, obviously are incented to have turnover so that, suite renovations and so on can happen, building improvements can happen. And turnover is definitely slowed down during this pandemic, as has some of the construction on the sites. I see, though, that as this evolves through the summer, I see that number increasing. And, if we see, a leveling off of cases and deaths and so on, as long as there isn't another spike, I mean, I would hate to see, for a whole bunch of reasons, a spike in the fall, like is being discussed by some scientists. I mean, that could come at a time that would be very difficult for our sector. It's the summer is when people tend to move. Obviously, this summer is going to be different than last summer or the summer before that. But we're watching it closely and just trying to do everything we can in the market we're in. I actually can't believe what's changed in the last week, just in terms of just behaviors that we've observed in our buildings. We're seeing increased requests for regular maintenance. Like the last week, they've seen a huge spike in tenants sort of more comfortable to have somebody come in and work in their unit, where before, they were, as I said before, they were as incented as our staff were to just stay apart and be safe. Now, the mentality is, what, it's been enough time. I'd like you to come in and do this non-emergency repair now. So I think this is gonna unfold over the coming weeks and months, and God willing, we'll get through this sooner than later.
Yeah. Okay, guys, I've been given the notification that this stream automatically turns off in 5 minutes, so we'll move right to finishing up here. And one question for each of you, starting with you, Matt. Actually, in 6 months from today, do you think values are going to be up or down in the apartment industry?
I think they're going to stay about the same, to be honest. Debt's cheaper than ever, which no one ever talks about. They just focus on the rental stream. I think Mark hit it. The turnover is just as important as the rents, and unlocking that, mark to market. I think they're going to stay the same, to be honest. I think there's robust demand. I think the market was out of balance before. I think it will remain. People still want good quality product with value add potential. That's my position. Same.
Right. And sorry, just going around the rest of the circle, basically any closing kind of comments you have, just for the, everybody listening is in the apartment space. What are your thoughts on the apartment market going forward? Tony, you can go ahead.
I'm probably the least qualified to talk about market in general. That's why you have bright guys on the panel who can share with you those comments. I'll simply say, what has impressed me the most has been, the way the industry, I think I'm a relative newcomer compared to most people to this industry, but in the few years I've been part of it, obviously there are great people, great companies. You see in a time of crisis how people respond. And I would say that certainly my experience has been great stories, great examples of building staff working tirelessly around the clock, putting themselves at risk, going above and beyond to help their residents. And people like Mark probably will say, well, that's what we always do, and that's how we always are. And that's a huge testament to everyone that works in this industry. But as an outsider, relatively speaking, or a newcomer to this, I would just say that's really struck me. And it's not to say that we're perfect, and not to say that there aren't a lot of people who are struggling, but simply just I would just say that I've certainly been impressed by the level of the way people have conducted themselves in our industry, and how they have worked, really gone above and beyond to help people. And I would just leave it at that.
Yeah, well said. Rob, how about you?
As I said, I'm pretty optimistic. I think there, as Mark talked about supply a little bit, I mean, I think there's lots and lots of demand, shortage of supply. I think we're going to get back to a new normal by the fall. Now, how that affects the different submarkets is you know, a longer discussion. Like Mark said, we've seen really strong results in smaller town Ontario. And some of it's demographics. You know, there's a lot of factors at play there, but some of those markets are literally unchanged during the pandemic for us. And I think, you know, I think the big markets, GTA and so on, will come around. I'm bullish.
Yeah. And then Mark, last words, if you could be quick though.
Yeah, I think that it's a pandemic. So I think some segments have been hit hard in multifamily, others have not. I think that'll be misunderstood by the market. So I think that there'll be short-term pain in certain segments of multifamily that are pandemic related. And the smart real estate investors will see either beyond that or recognize the longer term trends. So that just because I've got a seniors building in Sudbury doesn't mean that's the only possible investment. Maybe the urban centers that have been highly impacted by service workers will return and be a better investment. But the pandemic will really play with people's thinking, and I think most will get it wrong.
Wow. Okay. Well, thank you everyone. I think, and by the way, I think that the final message was buy CAPREIT stock. And thank you to all our panelists, Mark, Rob, Matt, Tony. Having a diverse set of opinions and expertise is critical to moving the conversation forward. So really appreciate all of you being here. And yeah, optimism. Multifamily is here to stay. So, you know.
Thank you so much.
Thanks, Dayma.
Thanks a lot. My pleasure. Take care.